Thanks for listening to The Derivative. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.
Welcome to The Derivative by RCM Alternatives, where we dive into what makes alternative investments go, analyze the strategies of unique hedge fund managers, and chat with interesting guests from across the investment world.
There are funds and categories, particularly with ETFs, that you should not expect there to be liquidity there. Now, the interesting part about this last crisis is people are saying, oh no, the bonds, ETFs are trading at big discounts to net asset value. But in reality, what was happening was the ETFs were actually probably the correct price. And the indices and net asset values are stale.
Hello, and thanks for joining us for another episode of The Derivative. I'm your host, Jeff Malik, and back with you podcasting from home due to the coronavirus lockdown. We're excited to have with us today a trend-following, farmland-loving, surfing, skiing, author, asset manager, and FinTwit must-follow. It's Meb Faber of Cambria Investment Management. Welcome, Meb.
Hey, man. Great to be here.
Great to have you. So, Meb, you run an ETF shop. You're a popular podcaster, author of a blog, white papers, and books, along with being an industry thought leader, along with the Meb Faber Show, your podcast, and somewhere you find time to be the CEO and CIO of Cambria. So you've authored 6 investment books. Some are offered on your website for free, and are kind of an all-around asset allocation research geek. Hopefully you don't take that the wrong way. So we can't get enough of your work, so thanks for joining us today.
Yeah, man. What are we going to talk about today?
Well, first I got to know what that lid is. What is that? Nuggets? Old school nuggets?
Yeah, man. I'm going through all my don't shower till 5 p.m. hats during the day. So this is, I'm a Colorado native. Grew up a little bit in North Carolina. So this is Nuggets, which obviously are not playing right now, but have a pretty good team. Colorado sports have sort of flip-flopped over the last few years. I grew up Broncos being the only game in town, but for a while the Avalanche were good. Nuggets were always terrible, but they've been pretty decent last few years.
And that's the old school, right? The old school Nuggets was that rainbow jersey.
Beautiful jersey. Some of the best. Alex English back in the day.
I was going to say Alex
Van
English.
Issel.
Quick story. When I lived out in Aspen for a year and a half, which we can get into later, ski bump, but I was a Bears fan from Chicago. So a buddy called me. He's like, hey, the Bears are playing the Broncos. And I'm like, cool, you have tickets? He's like, no, but I'm working security and I can get you in on security. So I worked the security at the Bears Broncos games, and I just had my arms facing the field the whole time. The supervisor would come through every 10 minutes and be like, you're supposed to be looking at the crowd, not the game. I'm like, oh, sorry. You can fire me as soon as the game's over.
Yeah, that's awesome. I have a lot of fond and some not so fond memories of my going to the games in the snow. My parents would just put us on a bus and send my brother and I there. And he's 7 years older, so there's definitely some times I came home in tears for him not opening the hot chocolate or just kind of abandoning me. So people sledding down the stairs, a lot of good times and some not so good times too. 3 Super Bowls, man. It was you learn a lot about being an investor as a Broncos fan during my formative years.
And so what was first, Colorado or Carolina?
Colorado, then Carolina, back and forth for a while, then been out here on the West Coast. Most of my crew is Colorado now.
What, split parent situation or what was
some and then kind of went back and forth, and then school on the East Coast, then out to San Francisco, then Tahoe for a couple years, and then down to LA ever since.
And so what do you prefer, surfing or skiing?
Man, I'm pretty adaptable. I like them all, depending. I was all revved up to do some serious skiing this year. I went to a really wonderful conference in Jackson Hole And then that was sort of the finale. At the end of February, all the resorts started getting great snow and shutting down one after another. So it was a short season, but maybe if this all clears up, we could head down to South America and catch the summer season, perhaps in August.
I got my Icon pass. I've been looking at that. I'm like, what's the South America resort I can head down and hit? I thought there was going to be a lot more like avalanche deaths, right? Of people in Colorado just like, I got to get out there, man. I'm going to hike. I don't care what the conditions
Going backcountry, yeah.
But I didn't hear too many of those articles. So, Meb, we've known each other for about 10 years or so. Embarrassingly, I think the first time we met was live over a webinar. I don't think it was video back then, but I didn't really know who you were, and I was trying to show up a little, and I called out your use of a certain man's futures mutual fund in one of your products live with a bunch of wholesalers and investors listening. So if you remember that, I apologize for that.
No, I don't mind.
If not, water under the bridge.
Sure.
But you're still using quite a bit of trend following, correct?
Yeah, you're starting quick on a pretty philosophical bent on what that means to all of us. I think most trend followers have a probably somewhat similar view of what it means, but you think kind of really broadly speaking, you could characterize almost most of the money in the world allocated as some form of trend following already. But in the traditional sense, yes, we use probably more trend following as a percentage of our allocations probably than almost any RIA or institution just about in the world that I know of. So we're pretty outlier there.
And tell me a little bit about that journey, because you were an RIA first, correct?
And then super 1 minute backdrop was, out of college, engineer, biotech, started out as a biotech quant analyst, started as a biotech fundamental analyst, then gravitated more towards quant analyst. That was the time in San Francisco and then Lake Tahoe. When in Lake Tahoe, I was working for a startup CTA that didn't go anywhere. Did some of the original.
I think we worked with those guys. What was the name of that? Incline?
Yeah, right in Incline Village, down the road from Miss T's Rotisserie, some of the best rotisserie that's still there right now. And I had a Mount Rose Pass. That's a nice secret where it was some of the best shoots in all of the Sierras, certainly. And a local mountain that just opened there and got great snow. But I had a similar situation to you, talking about your Broncos story, with a lot of local buddies. One worked in the ski shop, one worked on the mountain, and one worked in a hotel. So between all those, we had every possible freebie covered for the locals for a couple years. But yeah, so I did a lot of trend following research at the time there, much of which laid the foundation for what became some of the beginnings at Cambria, which got started. I moved down here in 2005, started managing a company. Started the company in 2006, started managing money in 2007, and the origins were all trend following. A lot of it came out of, we did separate accounts and private hedge funds. Most of the philosophy was in trend following. So, we wrote our first paper and blog at sort of the same time. This would have been published in 2007, and then became book, and, fast forward all the content we've done since then. But was pretty accidental at the time. But yeah, the origins were very much with a trend following foundation. And fast forward, over a decade, it's morphed a little more into a pure public ETF company, and we can get into reasons why. But again, the main foundations still very much has trend following as a huge component.
But then so when you first moved to LA, you were in RIA with clients that you were managing bespoke stock portfolios and whatnot?
So we started the firm with my partner, Eric, with no clear pathway of what we were going to look like when we grew up. And so
just like in all the business books, right?
And so he'd come from a venture capital, corporate sort of background, VC, corporate law in-house. And so we started it with the idea that we knew we wanted to be an asset manager, somewhat agnostic as to how it got delivered. When you're starting from zero, like full bootstrapped, as a scenario where we weren't going to try to pretend what it was going to look like. And for us, that meant private funds and separate accounts. At the same time that the company got started, because of this writing, we started to get a lot of attention from various, inbounds all over, some from the academic community, because we published this first paper in the Journal Wealth Management pre-crisis. I think my first client actually came from editorial I wrote in the newspaper, like an op-ed, which I've never done before or since.
What was the newspaper?
I think it's LA Times. I think I wrote something about pension funds, which humorously 10 years later, I think is finally starting to probably become a big problem here soon. So, but at the same time, started writing the blog, and all of that started to create this sort of flywheel of attention. And as you know, for someone who's, doing separate accounts and private funds, it's a lot easier to have a public fund as far as people investing. The private funds, they got to read these, all these documents and sign them. Back then it was fax or mail them in. They're 50 pages long, these private placements. It was just hard way to start from a group that wasn't coming out of Goldman or coming out of, a pedigreed shop or hedge fund, but doing it from scratch. And so we started with investment, separate accounts, and private funds with a pure trend following approach in the beginning. And as we started to write more, we had a couple opportunities to sub-advise on some funds, some that didn't get off the ground, some that did, and then eventually said we should be launching our own funds, which we started doing, I think, in 2013. And yeah, fast forward, we have 11 now, and let's see, another half a dozen filed and a few more probably in the queue. So we'll probably settle in that mid-teens range somewhere.
You're a lot smarter than us, because we're still doing the privates and the reams and reams of paperwork, although DocuSign's made it a bit easier. But yeah, you still.
Yeah, I mean, look, each type of structure has its own benefits and drawbacks, for sure. The biggest one with the public is that it's not sticky in or out. People can log into Robinhood or E-Trade or Fidelity or Schwab or whatever it may be and buy and sell every day. Whether you have an advisor, so on the separate account side, or even private fund, perhaps, and maybe not, there's a little more friction with trying to sell an investment. You have an advisor to talk to, particularly if you're on the financial planning, that may prevent you from doing really dumb stuff, but not always, of course. Yeah. At the end of the day, it'll probably be more based on just how the funds perform over time, and we can talk about time frame at some point. But yeah, each vehicle tends to have different benefits. The ETF structure, which is what we've gravitated towards, had a lot of benefits for us, and over the years we've adopted that. But still, I'm fairly agnostic as to structure. If something better comes out in a year or two, we're open to that too.
Let me jump back to a little personal. Maybe we'll weave it back into the beginning. But so I asked you about surfing. Did you surf before you moved to LA, or you?
Not really. I mean, been like a handful of times in the Outer Banks in North Carolina, maybe Waikiki or something. Nothing particularly too much other than just playing around.
What? How many times you get out a week? Just so I can be jealous.
Zero now. They closed the beaches. Quarantine was totally fine. It was no sweat until they closed the beaches, and now everyone's going insane. But I'm highly impressionable on who drags me out to do whatever. So if I got a lot of friends that are playing volleyball, I'm happy to kind of morph into that. If they're doing mountain biking, skiing, surfing, I'm easy to convince. So surfing was highly dependent on who's around to drag me out 6 a.m. I'm not a morning person, so yeah, it varies quite a bit.
And you're the kind of guy who's going to go like challenge the locals at their local break, or you're more?
I'm terrible. I'm still like, you get me on the Costco foam board, the Wavestorm. I'm happy as a clam. It gets much bigger than shoulder high, and I'm watching from the house with a coffee.
What's coronavirus? What's the lockdown like in LA? Where are you in LA? You're in Manhattan.
I'm in Manhattan Beach. as it began, I mean, I think probably the same experience for most people. People have become more serious as time has come on. We're recording this mid-April, where hopefully, knock on wood, it seems like we're turning the page a little bit. Things are getting better, but for a while, in the early days, people, there's a park right across from my house, and people, would occupy every inch of it. And then they decided to close it, law of unintended consequences. And so everyone just used it as a track, which concentrated everyone even more in a small area. But I think the beach, look, you got to do what you got to do to get past this. But the beach, I think, was hard for a lot of people in the parks because it was raining for a couple of weeks, which wasn't a big deal. But now it's beautiful. It's supposed to be 80, I think, tomorrow. So for those that have access to the outdoors, it's a lot easier than for those that don't.
I'm scared for Chicago because it's been pretty much the worst weather, March and April, that we've had in a while, which has helped keep people inside. But right, as soon as it's a 65 degrees sunny in Chicago, I mean, people are going to be out like crazy.
I'm about 70-80% sure I had it already. So if we get these antibodies tests, I'm certainly volunteering to get back in the action, but who knows? By the time this publishes, I imagine the world could look very different, whether in 24 hours or 2 weeks.
I hear you. And then I've seen on your Twitter, which you do a great job on Twitter, but you were starting to run some polls on like how many people. What led you down that path? That's pretty interesting.
I mean, in the beginning, my understanding was that, in thinking about markets, so we wrote a paper called, or a blog post, Investing in the Time of Corona. And I wanted to lay out a way of thinking because, a few weeks ago, stock market, other markets were going up, down 5-10% a day, oil, you know this. And so it was a pretty volatile time. And I said, look, the whole point of everything we do is trying to make a plan before it all hits the fan, and spent the last 10 years trying to educate investors, and don't even really care what your plan is necessarily, but at least having one. And the analogy we give is whether it's John Elway or Peyton Manning more recently, or Drew Lock, coming to the line of scrimmage, they prepare, they see what's going on, they can audible, but there really should be no situation in which case they're like, oh man, I have no idea what this defense is. I've never seen this before. I'm unprepared. And so at least having an idea of what the possible scenarios are.
That's Mitchell Trubisky. Trubisky is the one without the plan.
Exactly. And so he's like the investor without a plan, just winging it. So
I smell a blog post.
We came to this with that message for the last 10 years, and we wrote a bunch of papers on this: the zero budget portfolio, the investor pyramid, just how to develop and have a plan. And so we laid out in the beginning of this article, I said, look, the struggle with geopolitical and events and markets is the future is uncertain. That's the way this all works. We don't know what's going to happen. If you do know the future, you're fooling yourself. And so I said I could very easily, and this was in early March, lay out a bull and a bear case, for example, for how this plays out. I said, the bull case was that the U.S. Healthcare system, fiscal monetary responses were effective. People self-quarantined, tests were plentiful. The treatments were developed, vaccines were constructed and distributed. It was a very mild flu-like sort of experience. It never comes back, and the world moves on back to all-time highs in stock markets by summer or the end of the year. On the flip side, you could come up with a scenario, and this was at the time when everything every day was just going up in Italy and elsewhere, was that, the U.S. and other countries, despite their best intentions, treatments were ineffective. The virus spread uncontrollably, particularly in emerging markets, and Hospitals were overwhelmed. There were no treatments. Vaccines were years away. And even though perhaps the virus went away in the summer, people had hope, they got back to normal, and then it hit again in the fall and it was twice as bad and mutated, yada, yada. Both of those, not out of the question of possibilities. You could say what's more probable. Anyway, long-winded answer to your comment was that, in the beginning I said, I thought my hypothesis was that as this became more real for people, meaning as they started to know people that got sick and died, as perhaps famous celebrities or politicians got sick and died, it would become a lot more real and things could get a lot worse as far as sentiment. But I said, no matter what, you have to be prepared for both. And if you're trying to bet your portfolio, life savings, whatever, on just one outcome, that seems like a pretty, in my opinion, foolish way to go about it. So anyway, we started doing the poll, and in the beginning, yes, it makes sense that beginning, no one really knew anyone. Everyone seems to know someone now, but most likely everyone knows someone. They're just asymptomatic and haven't been tested.
Yeah, we pulled it on March 14th when you first started was 8%, and April 9th was 40% of your Twitter followers who are clicking it. Yeah, my wife's aunt and uncle both got it. They'd been on a cruise in Egypt. He just got out of the hospital, actually, and he did a 4-mile walk today or something. So
good. Well, good to hear you recovered.
All right, thanks for joining us. We've got author, manager, and alts expert Nev Faber here with us today. Let's get into Cambria a little bit. Is it Cambria or Cambria?
Cambria.
So you're CEO and CIO of Cambria Investment Management, which puts you in charge of all these different ETFs and separate accounts. So run us through all the different ETF products. I know we don't have 6 hours, but in a quick 30,000-foot view, if you can.
Yeah, I think it's important to kind of give the broad philosophy of the type of funds we launch first. I mean, one is we try to only launch funds that either don't exist or we think we can do much better or much cheaper. And in a world of tens of thousands of funds, that's pretty rare in all the categories. It has to be something that there's hopefully a fair amount of academic or practitioner research. Either we've done it or basing it on other people's as well. It needs to be something that I want to put my own money into. There's so many funds, in particular mutual fund managers, that have no investment in their own funds, which is a crazy situation. Lastly, is it something anyone actually wants? I have some ideas that I think are absolutely amazing, but good chance no one will ever buy them. And so, of the 11 we've launched, they can be either super niche-y and weird. Some are allocation and pretty broad, meant to represent your entire portfolio if you wanted. And then in between, it's everything from equities, long only, to even some inverse tail risk, to some tactical trend following. The two big pillars, no matter what, are value investing and trend following, both of which have been around for over 100 years. It's our little flavor and interpretation on those. And we have this belief that in 2020, and we've been talking about this for a long time, the investment world is bifurcating into this barbell of essentially free market cap weighted indices and funds. Bank of New York just launched a legit 0% equity market cap, large cap fund and a bond fund. And then on the other side, if you're going to charge whatever you charge, 50, 100, 200, 2 and 20, 5 and 40 fund, it needs to be weird, concentrated, and different enough that you can charge for it and hopefully generate alpha or better returns. So we try to exist in this corner of weird and different. And of the funds, it's a pretty diverse lineup. Happy to talk about any of them under that umbrella.
Just quickly, do you ever feel like you're like the regional hardware store going up against Home Depot or something? Like against these BlackRocks and all the rest?
In my mind, we've said this for a long time, is that market cap weighting investing is a commodity, and the bad news about a commodity from someone who deals a lot with them is they're replaceable. And so I don't want to play in a game where it's already at zero. The asset management industry has some of the highest margins of any industry in the entire country. But there's a lot of fat still there, but it's a lot of people who just don't do anything. These closet indexers that still charge a ton, and just, you get the S&P 500, which is the last thing you want. And I think they're dying.
Rent seekers, toll collectors, whatever you want to call it.
100%. And that's, our parents' generation, that's the way that it was. And my belief
is they take them golfing is why they get paid.
It'll get better, one funeral at a time, as people get divorced, probably a lot more of those after this, after this quarantine ends, as people die and pass along assets. No one goes back to paying 1.5-2% for a tax inefficient S&P 500 clone fund. That's not the way the world advances. And so that trend towards market cap weighting, zero cost, it's amazing for investors. Fantastic trend for the end investor. Horrible for those asset managers that don't know it yet. And so, I'm of the belief a lot of asset managers are already out of business. They just don't know it yet. And so they're slowly just riding the dividends of their assets and earnings until they all just go poof. I hope there's a blockbuster Netflix moment when they all just go out of business, but I think it'll actually be more of a slow progression over decades, honestly.
And by asset managers, you mean the RIAs, or like who are running publicly available funds, running mutual funds?
I think the most at risk is fund managers that don't do anything, meaning there's no what we call active share. They don't look any different than the S&P 500, which is free, and they charge 50, 100, 150, 200 basis points. I mean, there's thousands and thousands of those funds. On top of that, I think, and you can extrapolate that to any asset class. I think it also applies to financial planners or RIAs that aren't delivering any value. I think you're worth your weight in gold. You can charge 1% for the next 100 years, probably, if you deliver true value-added services like estate planning, taxes, behavioral coaching, all that stuff. But the basics of buy and hold asset allocation, you just go buy a bunch of ETFs, charge 1%, that's gone. Like that is not a future-proof job. You will be out of business. Vanguard right now runs a digital advisor that will give you a portfolio, rebalance it, all that good stuff. It caps it at like 0.15 or 0.2%. So the whole point of all this is you have to be value add, otherwise you can't charge for it, which is the way it should be.
Got it. And as altruistic as you are, you're not in it just to help people out, or you got to keep the lights on, right? So it's, hey, I'm trying to build a product that's good for you, that you think you need in the portfolio, but right, I'm adding value and I need to get paid for that value.
Yeah, I mean, so I'll give you a few examples. We launched a series of funds based under this banner of shareholder yield, which is this concept of, there's tens of billions, hundreds of billions of money allocated to traditional high yield dividend strategies. And we come from a very different philosophy that just makes absolutely no sense. Thinking about cash flows holistically and the ways that companies return cash to shareholders, thinking in terms of dividends and net share buybacks or share issuance, you end up with, and applying a value tilt, you end up with a much better portfolio. You end up with a much better performing set of stocks all the way back to the 1920s versus a high dividend yield approach, which really just gets you in traditionally kind of junky companies that are expensive, junky companies that have a slight value tilt, but have a high yield, which, by the way, if you're a taxable investor, you actually don't want. So anyway, we launched some of these ideas, and, I think it takes time to convince people, because certain belief systems, they have a great brand, and there's nothing in investing that has a better brand than dividend stocks. and so it's something that takes time for people to change their minds about, but hopefully there's some people weird enough out there that'll agree with us and vote alongside us with their investment dollars as well. But that's a good example of an idea that is a massive, massive, massive amount of capital that's completely, in my mind, allocated with a philosophy that has no footing.
And this is one of your books, correct?
Shareholder Yield is a book, white paper. Yeah, all these are free on our website. I mean, the concept was that, particularly in the US, starting in the early 1980s, companies started distributing cash flows through buybacks, which this will offend most of the listeners. It's Finance 101. You learn this as freshmen in college. Buybacks are the exact same thing as dividends if you say there's no tax advantage and they're trading at intrinsic value. Well, buybacks are more tax efficient than dividends, and you can buy stocks when they're trading below intrinsic value. So in Buffett, there's no better example of this than Buffett, who's never issued a dividend for Berkshire.
Jimmy or Warren?
Warren, back to the 1960s, where, he said he must have been in the bathroom when the board decided to issue the dividend. So he understands they're tax inefficient. He doesn't want to pay them. But he's fully on board with buying back stock, has been and will continue to do so. But he's smart and he does it. He has a quote that says something along the lines of, if a stock is trading below intrinsic value, there's no better use of cash flow than to buy back stock. So Charlie, his partner, says this all the time, where he says, you want to buy the cannibals, companies that are reducing share count, eating themselves, because it's a much more tax efficient dividend. So if you look at it holistically, combining dividends and net share buybacks and buying these stocks when they're cheap, and this is the biggest problem with the dividend funds. If you have a dividend strategy that doesn't account for valuation, all you're doing is buying high yielding stocks that are expensive.
Yeah, end up with a bunch of MLPs that go out of business, right?
It's bananas. And so on top of all that, that's the theory, that's the fundamental understanding. It makes sense. And it also applies to foreign developed and foreign emerging. And then you go back and test it. And we've showed this in our research, many papers and books, some going back all the way to 1920s, that shows this is a much better portfolio than any way of constructing it based on yield. And all this really is, at the end of the day, what you get to the core, any idea you should be able to explain to your niece, nephew, children, say, what's the core concept? You want to be buying companies that are cheap but high quality and have tons of cash flows, which is what you're buying here, right? You're buying companies have the ability to generate cash flows, distribute them, but also are cheap. And so you need a quantitative metric, or don't even need quantitative, but that's what we do, just shows that these companies are cheap, rather than last thing you want is a company buying back stock that's expensive, which CEOs are, they're empire builders.
Does that help you with a company like Apple, who was forever didn't pay out dividends, like to identify someone like that you could get into a lot sooner?
Apple's a perfect example. It's been a long time holding where, they're not going to be owned in either. There's the dividend side, I have to check recently, but it's roughly about the same, where they pay out both dividends and do buybacks. And so, and it's important to note, you don't want a company that, the reason why you have to use net share issuance, you don't want a company that's just using buybacks to mop up options that are awarded.
Yeah, I was going to ask you what you thought of Ben Hunt's work and all this of.
So the big challenge, and I love Ben, but the big challenge with, I think, a lot of the commentary around buybacks is it's a good bad guy. It sounds good. I mean, I said that, talking about branding, the worst thing people ever did was calling them stock buybacks. They should have just called them tax efficient dividends, which is what they are.
Yeah.
And so the thing that people are hitting on, that everyone knows that something feels a little off, is that they're upset about high exec compensation. They're upset about companies that pay huge options to their management, and then particularly are highly leveraged, and then get in trouble, like a lot are this year, and come running to the government. All that feels bad. I agree with all of that. The problem is, it has nothing to do with buybacks. Compensation is a board issue. if the board ties your compensation to buybacks, which they never should, then you just have the dumbest board on the planet, and the board should be cleared house and should be in jail. That's just stupid.
But it exists, right?
Right. And it's just so dumb. Why would you ever do that? It has nothing to do with buybacks. Now, again, the whole key of a CEO's job is that he needs to divert cash. And there's only 5 ways to manage cash if you are a company. It doesn't matter what the company does. It's reinvest in the business, which is the sexy part. It's, you could buy back stock, pay out dividends, pay down debt, or go acquire another company. And that's it. There's nothing else you can do with that money. And it's funny to see how the mood about the public has changed. Everyone's always hated the CEOs, right? The empire builders that do dumb things. But if you go back in history over the past 100, 200 years, it's actually the case that the government and shareholders often either required or heavily preferred companies to do buybacks, because the last thing they wanted is the company to have a bunch of extra cash sitting around that would they then pay themselves or go name stadiums or buy buildings, right? So it's funny how the mood has changed. At the end of the day, the best advice, if you wanted to fix this in a very simple, write it on a napkin, it's 2 ways. One is you de-link executive compensation from short-term earnings per share and stock price. I mean, that's silly anyway. Yeah. 2 is that you just make dividends on par with buybacks tax treatment. Dividends gets taxed twice, buybacks don't. So just say dividends are tax-free. Done. That's it. Yeah. Now, politicians aren't going to do that. The same reason they're not going to get rid of the lottery, because they like the tax revenue.
I hear you. So a few things to unpack there. One, we'll get off buybacks and the dividends, but just ETFs in general, and we touched on the passive ETFs that are tracking the market weighted, tracking S&P or whatnot. What about these conspiracy theories or fears that is going to somehow infect the market during a crash? I think we just proved in March here that it didn't happen, but people are fearing it's going to disconnect from the NAV. There's going to be problems with redemptions. And what do you see being an ETF creator that would disprove that or give credence to that feeling?
Short answer is it's silly and there's nothing there. The longer answer is you got to remember ETFs are just a structure. ETFs are essentially just a mutual fund that happens to have daily liquidity, and it's a more efficient mutual fund for equities in particular because of the creation and redemption. And if you go look back to the spiders back to the late 90s, they've never paid essentially a capital gains distribution. So it's vastly more tax efficient if you're an equity manager, or if you do, doesn't matter if it's index or active. The entire active mutual fund universe, if you're allocating to an equity guy there, I would call them up and say, hey, you got to launch an ETF if I'm taxable, because it's a much better just structure. And that's just a little bit of a nuance of the tax code. Again, if the government was really on top of this, or the SEC would just wave its wand and say mutual funds should have the same tax treatment as ETFs. It's really not fair. Being an ETF manager, I don't care. I hope they all go out of business. But that's just the way that it is. You cannot argue that point. There's probably for the active equity funds a 70 basis point tax per year cost on average of the mutual fund structure versus ETFs. Forget about expenses. Okay, ignore all that. So ETFs, there's nothing unique about them. They're just another fund type. And by the way, they're tiny. They're a speck of sand compared to mutual funds, compared to sovereigns, compared to individual investors, everything around the world. Like, it's just rounding error. The thing that people do have correct, and this has nothing to do with ETFs, it could be anything, is that any fund you have that's buying illiquid stuff that thinks it's liquid. So let's say you had a hedge fund that had daily liquidity that was investing in Brazilian small cap tech names, and it was a $10 billion fund. And all of a sudden you have daily liquidity and someone says, I want $5 billion out. Well, obviously you can't. That's just not, it doesn't matter if it's a hedge fund, a mutual fund, a separate account, an ETF, whatever.
Right. Or distressed debt or things of that nature. Like there's,
and so there are funds and categories, particularly with ETFs, that you should not expect there to be liquidity there. A lot of the bond ones where you're investing in corporate bonds, but expecting them that they don't trade daily, but you're expecting the fund to. Now, the interesting part about this last crisis is people are saying, oh no, the bonds, ETFs are trading at big discounts to net asset value. But in reality, what was happening was the ETFs were actually probably the correct price.
Yeah.
And the indices and net asset values are stale. So it's the way you see this is a lot of times is if a fund or a country or something will get halted. Let's say Brazil halts their stock market or Greece, but the fund keeps trading. And then you see the fund, the country stock market open back up, and it opens exactly where the ETF is. So it's a price discovery that I think is.
And in the futures world, you see that with if we're locked limit down in whatever market, and you can check the option prices and derive what the futures will reopen at.
Yeah.
They're definitely. I just had this debate with someone the other day. They're acting as the pure price discovery. And if all those investors could access that bond market right away, the prices of those bonds would be the same.
And futures is a good example. Like I'm not someone who's just going to tell you ETFs are the best thing on the planet. There's a couple areas, like I don't think they matter as much in retirement accounts because there's a huge tax benefit of taxable. So in retirement accounts, they don't matter as much. In bonds, it's kind of a wash. Futures, it's meaningless. Like if you're going to do a managed futures fund, there's no benefit of the ETF. There's probably drawbacks. So, but particular with equities and turnover and taxable, it's a great vehicle.
So back to the fun stuff. I think ETF naming seems like the last bastion of creativity in the financial space. How do you come up with some of these good names? You have Toke, which is a cannabis one, and Tail, which is tail risk. How does that process work of coming up with those fun names?
We just sit around over happy hour and try to come up with memorable names. You know, I think it's.
Then you got to check if they're available and apply to the SEC and whatnot.
Yeah, you can reserve tickers if you're an issuer. Typically, they don't want you squatting on a bunch. You have to have the intent of launching them. So if you have an active prospectus with a fund, you can attach it to is much more likely.
The guy, sorry, quick story on sitting on things. The guy in our office had bought Bloomberg2020.com for like $4.99 in 2018, and they were. He eventually settled for like 60 grand or something.
Good for him.
Yeah.
Good for
Convexity.
him. Yeah, exactly. Yeah. You unfortunately can't do a whole lot of that, squatting and selling the tickers. But, you know, I think, look, the ticker is memorable and helpful. We all know 5-10 years from now, the ability to get exposure and how the fund performs, you know, is going to be vastly more important than the ticker. You know, we're trying not to really be involved in the market cap sort of weighted exposure to a lot of these indices where the first fund to launch.
Talk about that a little more. You've mentioned that a few times. What's the summary of what you mean by that?
So let's go back 50 years, 1970s. And you invest in a stock market index, which technically had been around longer, back at the time of Dow Jones, but really the big innovation came in the 70s. Wells Fargo, John Bogle, Vanguard, and others said, well, if you just invest in the whole market, meaning you just bought all the stocks in proportion to their size, you could do this as a passive index. And everyone thinks that, by the way, the passive index was the big innovation, and it's actually not. It's that a passive index, because you don't do anything. If you go out and buy the 500 biggest stocks in the US, you technically never rebalance that as a market cap weighted. You do corporate actions if somebody buys someone, a business goes out, whatever, but you're not rebalancing that ever. So it takes no effort. You know, my dog could do this. He's a very bright dog, but so the benefit, the huge innovation is because it took no effort and a freshman in high school could do it, you don't have to charge much, and you probably shouldn't or couldn't be charging much. So all these funds that were market cap weighted funds that were charging 1.5%, 2%, or market cap weighted funds in drag, as a $200 basis point hurdle of alpha that you just didn't have to have. So obviously we know what has transpired since. Now the term passive and indexing has lost all meaning over this time, but to the real correct academic term, market cap weighting only means one thing. It's the price of a stock times shares outstanding, and that's it. And so that's a great first innovation, because you're guaranteed to own the winners. If we know anything about markets and investing and trend following, by the way, and that's the market cap weighted index is a trend following index. It's just price. As it goes up, you own more. As it goes down, you own less. It's like one of the simplest trend following systems in existence. It guarantees you to own the winners. And in the stock market, about 5% of the stocks generate all the gains. McDonald's, Amazon's, Walmart's of the world. And so, but it's not an ideal index, and it's not an ideal strategy. It's a good first start, and it's fine. But the problem with market cap weighting in stocks is that it has no tether to value. And so often as price goes up, many of the stocks valuation is simply going up. It's the P and the PE. So market cap weighting historically, if you avoid the largest stock in an index, if you avoid the largest stock in a sector or country, the largest holding underperforms that country, sector, index usually by 3 percentage points for the next decade and up in certain areas. But that makes sense. It's capitalism. By the time these get bigger, they are invite competition. They're expensive. They're the old stalwarts where the younger ones had better returns. So you could weight stock indices by any other methodology, equal weight based on valuation, based on momentum, whatever it is, doesn't really matter. They should all beat the market cap weighting by about 1% or 2% per year.
I have this debate with some advisors. They're like, oh, I don't believe in an automated trading system. I invest in the passive index. I'm like, well, you're actually in a trading system that reweights and picks these different stocks and kicks them out when they need to be kicked out. It's like, well, I've never thought of it that way, but yeah, you're in a system.
Market cap weighting is one of the oldest trend following systems on the planet, and probably manages more assets in trend following than almost anything else combined.
So your whole philosophy was that I want to capture that extra 1-2% by not market weighting and weighting or cape weighting, whatever it is.
And it doesn't really matter. I don't even think what you do. I obviously have preferences. We mentioned shareholder yield. Any of the valuation metrics, is a common sense to me idea that checks the common sense box of, is this reasonable? The nice thing about using value is not just you're overweighting the cheap stuff, which you are, but you're also avoiding the really expensive. The valuation metric you mentioned, which is the Shiller 10-year CAPE ratio, is just a 10-year PE ratio. We track all sorts of 10-year valuation metrics based on price to book, cash flow, sales, all that stuff. Even dividends, by the way, work just fine. But looking at countries, and this is a good example, as you talk about market cap weighting, it gives you an anchor, and it gives you an ability to say, is this a reasonable, what's going on in the world? So, coming into this year, if you look at the long-term valuation metrics of countries, the average PE ratio over time, this 10-year CAPE for countries was usually around 17. In many countries, it's been as low as 5. In the US, it's been as low as 5 and as high as 45 in the late 90s bull market, internet boom and bubble, my favorite. But in other countries, it even went higher. And the problem with that is if you simply avoid those expensive countries and tilt towards the cheaper, you end up with much higher returns over time. Keyword being over time. Doesn't guarantee you any given year or even month, quarter, week. And so going into this year, the US was expensive. It was trading around 32 or 33, which a very simple equation, by the way, for forecasting future stock returns is just dividend yield, starting dividend yield, dividend growth, plus change in valuation over the next 10 years. This is a Bogle equation, gives you roughly stock returns. And so the US, you plug in those metrics at the beginning of this decade, 2% dividend return, give it historical dividend growth, and then the change in valuation, you end up with low single-digit returns. Well, the market this year has gone from a P ratio of around 32, 33. I think it bottomed around 22 in March, April. It's now back up to 26-ish. But again, that's expensive, not terrible. Good news is the rest of the world came into the year trading around 22, hit as low as I think around 15. Emerging markets started the year at 15, hit as low as like 12 or 10. And the cheapest stuff started the year at 12 and ended up in like around like 7. Wow. And so, but the interesting takeaway from all that, we're spending this whole podcast talking about stocks and valuations on a trend following podcast, is that if you look at the global market cap, well, the US was over half at the beginning of this year, and you're putting most of your money in one of the most expensive markets in the world. Again, not a bubble, not crazy, but expensive. And so you're making the same mistake you would make within the US if you overweighted by market cap weighting expensive stocks. And the biggest problem with market cap weighting, it has the tendency to overweight bubbles. In the 80s, when Japan had the highest CAPE ratio we've ever seen of almost 100, that was the biggest stock market in the world at the time. So you should have put most of your money in Japan. Horrible idea. The US was really cheap then.
Fast forward now, it would have taken you 30 years to get back to even.
Yeah. And that's not, again, we often say this, that's not some backwater economy. That's not, the Philippines. That's still a top 3 economy in the world who's had zero stock returns for decades. And so, again, tilting away, it's impossible to tell people in the US this over the past decade because the US has had amazing returns. This decade is starting to be a little different. We'll see how it ends up in 10 years. And
there's been a big value trap the last 10 years, as you're saying, right? Like if you stuck with value the last 10 years, you're trailing.
But that's the way value works. We and you can certainly sympathize with us on the trend following stuff too. Any active approach or asset class is, we used to tell people when they would ask us how long should they give an investing strategy to play out to know if it works or not. We used to say 10 years and now we say 20. And people laugh and they think that's funny. And I say, no, I'm serious. Most institutional investors and most individuals, it's 1 to 3 years, which is such a horrible misunderstanding of everything that's involved in markets. Last month, there is no more ironclad belief in all of markets than stocks outperform bonds. Can you think of any? That's like the number one to me, is like stocks for the long run. You own stocks, they'll outperform bonds, and largely I agree. First quarter of this year, stocks for the last 40 years had no premium over long-term bonds in the US. Think about that. 40 years, that is a lifetime for someone to invest, and still the most ironclad belief wasn't true over that entire period that stocks had any premium over bonds. And so people will email me and say, Meb, I saw your fund did this last week, last month, last quarter, last year. And I'm like, buddy,
doesn't matter.
It can get way worse than this. And so, and so when you're talking about value, that's interesting because that's, for stuff to get cheap, it usually just means that the P went down 40, 60, 80%. It's usually not the earnings. It's usually just the market went down 80%. That's why it's cheap. And on the flip side, the stuff that's expensive is usually markets hitting all-time highs, which the U.S. was. But by the way, we have a new paper coming out. We are published as a blog post where investing at all-time highs is actually very bullish. And it's a great investing strategy, much to what most people think. But the whole takeaway is that, I think value is helpful as something to at least give you an anchor to look around the world to say, is what I'm doing reasonable? Is buying Japan at 100 reasonable? Is buying US in late 90s when I was in university engineering classes and the professors were trading stocks? Does that pass the smell test?
Right, at least give you pause before you put your whole nest egg in there and whatnot. But it seems to me like in trend following in particular, like you get paid, the return profile is almost based on people not having the patience for it. Yeah. Right? If they don't have, and value somewhat the same thing. I don't have the patience for that. I'm going to sell that. I'm going to go with the momentum stock, which drives it down and gives it that value.
We've been saying for a long time, we did a study you can find on the blog that put the U.S. stock market into 4 quadrants. And we said if you could put it into cheap and expensive historically and uptrend and downtrend, and what did the returns look like in the next month if you just characterize it every month? And not surprisingly, the best performing quadrant was cheap uptrend. The second best, though, was expensive uptrend, which is what we've had for a number of years now. And so we used to always tell people, say, look, when this flips from the best is cheap uptrend, worst is expensive downtrend. And that makes sense. That's the way you would probably think it was. But second best was expensive uptrend. But when it goes from expensive uptrend to expensive downtrend, which is the worst, finally, we got to it. That goes from the yellow to red flashing light, which is what happened depending on your indicator, but it certainly either happened at the end of January, end of February, and you're still there now. And so you would argue that that's not a warm, fuzzy, happy place when it comes to, and you can apply that to any market of equities as well.
And so what these valuation metrics and knowing as you do of this looks expensive to me, did that drive, the one ETF tail, TAIL, which is tail risk and trying to capture things like just happened in March of 2020 here? Was that the impetus for that product?
So we wrote another paper a couple years ago called Worried About the Market, it may be time for this strategy. And as stocks started getting more and more expensive, we would talk to advisors and say, look, or investors of any stripe, they would talk to us and their general concerns. And I say, look, if you own US stocks, the first step, if you want to hedge a risk, is just don't take that risk in the first place. If you have 100% of your portfolio in US stocks, maybe own 80. Okay, don't own so much if you can't sleep at night. Second is that you can diversify to other asset classes. So if you own stocks, you could buy bonds, foreign stocks, real estate, commodities, all that other stuff.
Futures.
We're getting there. Hold on. These are just the beta of asset classes. And so the problem with those is we look back to the 1980s and we said, what assets historically helped as a hedge? And obviously, not surprisingly, foreign stocks didn't help at all. Real estate didn't help. Commodities didn't help, the broad-based energy ones. And then bonds helped, but if the market's down 10, they may have been flat or up 1 on average. So they help, but not that much. Gold helps, but only sometimes. And what did I leave out? Anything? And then a tail risk strategy. Real estate doesn't help at all.
Yeah.
A tail risk strategy, which historically is that we described was just buying puts on the stock market, pairing it with 10-year government bonds, did great by definition, but of course it should. It's literally an insurance vehicle that is a cost most of the time and should do well when markets go south. But before we got to that, we said you can also do 2 active strategies. One, tilt towards value, because historically the expensive markets were much more fragile, and the future 3 to 5 year returns, you had a big fat drawdown more likely when markets were expensive than when they're cheap. 2, to use trend following. And I said, only then, if and only then, after you do all those steps, don't take the risk, diversify, add active strategies, only then would you probably add tail risk. But I said, maybe it's a thoughtful time to be adding it now, because the US stock market's expensive. It's been a 10-year bull market. A lot of the sentiment was pretty high, super low volatility environment. But more importantly, the point I made to all the people that are involved in asset management, particularly financial advisors, and no one took me up on this. I think like 2 people said this was an interesting idea. And I did this with a big slug of my own money as well as my company's balance sheet. We put about a quarter of all of it in tail risk, because I said, look, if you're the average financial advisor, you own US stocks in your portfolio. You personally, you own US stocks, everyone does, and that swamps the volatility. If you own a 60-40 portfolio, the volatility of the stocks swamps the bonds. So really you just own stocks.
Yeah.
Your clients own stocks. So if you're a fee-based advisor and you have 100 million and stocks go down 50, well, your revenue just went down 50.
And likely the same stocks, probably.
Probably the same stocks. On top of that, if you clients often, if they're just stock exposed, behave poorly when it all goes to hell, because buy and hold investors, the biggest problem is the bad times correlate with bear markets almost always with recessions, depressions, contractions, high unemployment. Look what we're seeing right now. Stock market pukes, unemployment goes through the roof. On top of that, if you don't own your own company and you work for, say, Morgan Stanley, their revenue is directly exposed to equities, and they may have to downsize because their revenue's gone down. You probably get fired. So you're like 5 times leveraged one risk, which is U.S. stocks. So my argument was, you should think about not owning so much. The average investor in the U.S. owns 80% of their stock allocation is in the U.S., when even as the global average, it should be 50. And if you do value tilting or GDP weight, it should be like a quarter. So already they're way overweight. But then on top of that, you have this multiple leverage. And I said, you could either not own as much, diversify, or start to hedge. I said, I could make the argument you shouldn't own any at all. Yeah. Airlines hedge fuel, cereal companies hedge wheat. Why wouldn't you hedge? And no.
They're crickets. Yeah.
Yeah, I don't think believed it, but it's good to see that fund do, in real time what it's supposed to be doing.
And it's buying puts on the S&P?
It buys a ladder of puts from about 2 to 3 months on all that way to about 15 to 16 months. In general, it's trying to get you roughly an inverse exposure. Going back to the very beginning of this podcast, when we talked about why do we launch funds, this tail strategy is a good example, because when we looked at a lot of the inverse funds, we scratched our head and say they're either so expensive or they're some extremely complicated. And I just want something that's just simple that I can understand. Put my money 90% in government bonds, buy a ladder of puts, and just be done with it, And so.
And the bonds pay for the put premiums?
So historically,
except for now.
It's funny because I spent an entire summer modeling and building a bunch of option databases, and then came to the realization I could actually back out exactly what we were trying to do from all the CBOE indices they publish. So It was good to see they matched, but in general, it actually had a positive return historically. I don't think that is realistic, because that existed in a world of bond yields north of 5, in the 80s, 90s, 2000s. We're at 1 now. Yeah. So I think it'll probably be a negative cost of a few percentage points per year. But the interesting part about this strategy, if you were to do an optimal allocation, if you were to take a bunch of assets, put them into an optimizer, first of all, I said this at a conference a few years back. I said, first of all, you'd probably have half in trend following. Yeah. And everyone always overrides that, if not more. There was I don't know if you've seen this, there was a Goldman study, I think it's Goldman study, that said, how much should we actually have in trend following? And they go through the exercise, and they had to constrain it because it said you would actually had to put like 80% in trend following. And they're like, that's unrealistic.
Yeah, nobody would do that.
I said, that's unrealistic. I'm like, what do you mean that's unrealistic? If it said stocks, you would of course put it all in stocks. Anyway.
And I've done a paper before of like the amount people put in trend following, you need like a 70% return.
Yeah.
In order for your 5% to pay out. And okay, I get it, I'm going to put a little crumb in. I'm like, well, you might as well do 0.
You really got to move in blocks of honestly like 5-10% for it to even move the needle. And so the thing about this tail risk fund is, I said, if you put in the optimizer, will it probably kick out an allocation to tail? And I said, it may not. It may say this is a suboptimal strategy. It's an insurance type of strategy where if you put in an optimizer, should I buy fire insurance on my house? Probably not. It's going to be, but if it does happen, the key to me is that did you have something that helps clients or yourself or investors get to the end game, which we all know the most important thing in all of investing is just surviving and having a bankroll to continue to play. And then the gravy on that is having the returns above that. And so, to me is in Q1, when everything is just getting destroyed with the exceptions of probably tail risk and bonds and trend following, is it nice to at least see something green on your screen? And does that help you?
Yeah, behavior. Survive? I've been saying that, and our friends doing the Mutiny Fund, which is a similar thing. But right, the biggest thing there is to help you stay invested. Right? Yeah. If you can have something that keeps you from panicking at the lows, like that's even bigger than any return you get. I think just the behavioral edge it gives you.
And tying in a couple threads from earlier, look, I spent a lot of this podcast, kind of dumping on dividends. But look, if you tell me, hey, I got some retiree, he buys 10 dividend stocks every year, rebalances and he sticks to it, God bless him. That's great. If you have your strategy and approach and you cash those dividend checks and it keeps you behaving, that's a great strategy over time. It's not optimal. It's not what I would do, but as long as it keeps you, in the game. And to me, that's kind of what, where we're talking about here is the behavioral aspect is vastly more important than the exact optimal allocation.
Right. You can have the optimal, perfect portfolio, but if you scrap it every 6 months and switch to the new perfect portfolio, you're going to way underperform a suboptimal portfolio. So, Meb, so you're talking all that about these people, maybe they don't have the optimal portfolio. Don't put all your eggs in one basket as a manager. So you kind of do that personally. You wrote a blog piece recently of what I personally invest in. Tell us in a couple minutes what you're thinking of there. Way more farmland than I would think would.
Yeah, I have another opinion, which is not widely held by almost anyone, that if you're doing buy and hold long only asset allocation, your allocation actually doesn't really matter.
I've seen your paper on that. You had like 10 different.
Yeah, we have a book called Global Asset Allocation that's free to download, that it looks at like dozens of asset allocation strategies. As long as you have the main ingredients, global stocks, some global bonds, some global real assets, you end up in a pretty good place no matter what over time. And they zig and zag. The 70s had different performance than the 90s, than the 2000s, whatever. But in general, just not mucking it up and not paying way too much, you end up in a happy place. But again, tying back into it, the problem with buy and hold is it all happens at once, and they're all everything, not just in your portfolio, but usually what happens in the real world is all at once. So recession, losing your job, all the news flow. I mean, just Q1 is such a great example. All happens at the same time. And so your portfolio, you would theoretically want it to hedge your human capital, but in reality, you're just doubling down on it. So my allocation of my public money, public assets, is half in a global asset allocation. So stocks, bonds, real assets with big tilts towards value and momentum. And so not just in stocks, but we do value in bonds, et cetera.
What do you mean by your public money?
What's that?
What do you mean by your public money?
Okay, so publicly tradable assets.
Got it.
And we'll get to the private stuff in a second.
Yeah.
And then the other half is in trend following strategies, because trend following, in my mind, is, if I had to pick just one strategy, I would pick that because it adapts, right? But the problem with trend following, often, depending on how you do it, is that you look a lot different. And you can go years with underperforming traditional buy and hold assets. And, the Buffett crew says, it's not greed and fear that drives people, it's envy. And I know I'm not immune to any of the behavioral biases. So, underperforming buy and hold when it's romping and stomping would be hard for me. And so I love trend following too. But trend following's problem isn't usually the bad times, the bear markets. It's looking different when stocks are up 30 in 2019.
Yeah.
So having the two sort of yin yang for me, we call it Trinity portfolio, I think is perfect for me. It's what I do with all my public assets that I can. In the retirement stuff, I just don't have the same choices. So I just throw them into emerging markets and international, whatever's cheapest, and just dollar cost average. Taking a step back, thinking about behavioral and psychological hacks, to me, for most of my life, I've thought private investments, the illiquidity has been a bug, when in reality, I think it's, for many people, an actual feature, meaning the fact you can't sell something is probably a good thing. And what do most people, their biggest assets, their house? If they could value that every day and sell it, with the flexibility to move, it'd be a lot different than if you just can't. And that applies to a lot of things. And so for me, that means one, being farmland, which granted, there's a lot of history in my family. My dad's side is Kansas, Nebraska. You can trace it back to immigrating there and being on farms for a long time. So there's some emotional attachment, but it's a fantastic diversifying investment. doesn't have a whole lot of correlation to anything. And I would actually like to own a lot more farmland of different stripes elsewhere, and would like to do that in the coming years. And then another big chunk is investing in other private businesses. So for me, startup investing in angel companies have done over 100 and probably 20 or 30 in the past 5 years, 6 years. And to me, the ability to invest in them, there's huge tax benefits now with qualified small business tax benefits to if you invest in a company below 50 million. The first 10 million or 10x gain is tax free. So, but you just put them in the coffee can portfolio, forget about them because you can't sell them in even 10 years, even if you wanted to. And if you actually look at that, so in the GA book, we talk about fund strategy that's 2,000 years old, and it's from the Talmud, and where it says, let every man divide his wealth, a third into business, a third into land, and a third keep in reserve. And I said, my portfolio looks a lot like that. So a third land being farmland. I'd put real estate and housing if I don't own a house, but other people would. A third in business, so all those private companies, and a third of cash sort of style investments, which is what I consider my public portfolio, which a lot of people wouldn't, by the way. We wrote an article about if you look at after inflation returns, you actually want to invest most of your cash, because if you look at drawdown and volatility, you end up with a much higher return for similar drawdown and volatility. Really long-winded answer.
And do you not own your house on purpose? You feel there's better use for the cash?
You depends
the
where
CAPE ratio on Manhattan Beach real estate is 600.
Depends where you direct this question, because to me, the first 5 best reasons to own a house is not financial. If you look at housing historically, it's probably has, in my opinion, probably close to stock-like returns if you rent it out, or if you live there, but you got to pay for the rent. So it's a wash. Yeah. I don't think a lot of people get that. The actual value of the house itself probably only keeps up with inflation. But if you were to consider leasing it out versus what you pay, it's a wash. Anyway, but I think most of the reasons are not financial. I think the biggest benefit of housing for the vast majority of people is it keeps you spending that money on something else. So the fact you have a mortgage payment every month, it keeps you from going on vacation and buying cars and all the other going out to dinner. So it's like a forced savings. It's like a 401k match. That having been said, I don't have the same romantic attachment to ownership of a house as my better half does. I see the black mold on the ceiling. I see the termites. I see the valuation in LA. Say, if you want to buy a house, sure, let's go look in Portland or Denver or Kansas or somewhere. But LA is bananas. Seems to be coming down now, but I'm a happy renter. We'll see how long that lasts.
A private equity friend of mine here in Chicago, he's got a huge place on Lakeshore, beautiful elevator, everything, rental. He's like, what are you talking about? I could put this money in so many deals and get like 5x, 10x over what I'd get in the
Yeah.
That might be the only other mantra financial than we talked about before of like real estate. You got to own a house versus stocks will outperform bonds. You got to own a house might be the other one.
And the funny thing is, you and I could probably sit here for 10 more hours and talk about, investing till the cows come home, like super sophisticated, deep and worth doing ideas and concepts. You talk about most individuals, it is vastly more important simply the equation of how much you save and invest in the first place versus your actual return. And most people, they just don't. They want to spend all the money, which is great and fun, you probably should. But, to actually create the compounding and wealth, you need time and savings. It doesn't matter if you're a janitor or if you're a doctor. It's easily doable for both, but you have to save it in the first place. And that's
right.
hard.
That's coming back to your post. We're all talking about the stay rich phase, right? Of everything we do and FinTwit and all the rest is mostly for people who've already gotten there. There seems to be a whole nother need in the world for getting people there.
Yeah.
Cool. We're gonna tie it out. Oh, I was gonna talk about the podcast real quick. So, you mentioned in the beginning the Meb Faber Show. It's your podcast. You've done 200 plus episodes, and you were one of the first there. Are you gonna sell out like Bill Simmons for a couple $10 million?
Sure, absolutely. You got a buyer? I'm listening.
Good. Yeah, go ahead.
It's funny because the origin story of it was that we'd considered doing it for years before we actually started, but had wanted to do a high quality video production and eventually polled the audience and said, what would you rather have? And people, and this is years ago, said they would much prefer a podcast. And this wasn't the earliest podcast, but kind of the second wave. And that it was like 80 or 90% said podcasts, audio only. And that was a big realization to me that, oh, okay, maybe people want to consume this in a different way than I had thought about. But we've come full circle now because video actually works so well and we're all quarantined. And video is so much higher quality and easier to do, despite what you see as my guest bedroom if anybody wants to come for a visit.
I'm in mine as well. To me, my biggest thing with the podcast is I can listen to them. I listen at 1.5x.
Yeah.
So I can rifle through them. And video to me, a lot of times I'm like, I want it to go faster. I don't want to look at the person sometimes. So, and it's easier when you're doing something else. Like it's hard to watch a video and drive.
Yeah.
Or
go to the gym, walk the dog, same thing.
Exactly. So who have been some of your favorite guests you've had on? And I'll preface that by I like the ones you do. I listen quite a bit. One of your shows, one of my favorites on there. But the ones where some of the companies you invest in and hearing those stories are great.
Yeah, it's funny. We do like about 4 or 5 different types. We do the traditional chat with people. We do what we call like a radio show, which is like a Q&A. We've started to do more entrepreneur ones, just because I think it's so funny when you look at public market investing versus private. Because public market, it's like all the news flow is always terrible. It's like the world is ending, geopolitics, just economics, just awful. Like all you want to do is go buy tail risk all day long.
Right. The rule in our office since 2002 has been no volume on CNBC.
Yeah.
Like the data is fine, but the rest is just complete pure noise.
And so, but on the flip side, like looking at these private startup companies, the smartest entrepreneurs in the world tackling like the coolest problems. All I want to do is invest all my money into all of them. Like I'm like, that's the best idea. It's amazing. It's going to change the world. And
so like Steve Martin in The Jerk, like another check.
Trying to find the balance, I think is challenging, but useful. And so we do the entrepreneur ones. We do some where we're reading research, and then I'm leaving one style out. But for me, there's often very little correlation between what I think is a phenomenal episode and what listeners do. Often people, I'm like, that just wasn't that interesting. And we'll get tons of response from people like, that was so helpful. Thank you. I loved it. We always get haters. Like that's guaranteed. People always hate the episode. But the ones that people really like, I particularly like the ones where it's someone who's maybe not that well known. Obviously if you get Buffett on your podcast, it'll probably be a great podcast, a lot of listeners. But to me, I like trying to give the opportunity to find some uncovered gems, whether it's new fund managers, people doing great research. I love the old school guys who maybe the younger generation doesn't know.
And we just did one with Salem Abraham.
Oh, cool.
Along those lines. He's still kicking it there in Canada, Texas. Was great.
Yeah. And he's got the farming background too, right?
Yeah.
Or ranching, whatever the combo is.
Yeah, he's got a apple farm, pecan grove,
and,
something else, peaches or plums or something. So yeah, we were definitely in that like 7th wave of the podcast, mainly because we couldn't get it through our compliance.
Yeah.
So we had the big long disclaimer at the beginning, but we got a new compliance person last year and finally pushed
Am I looking at the new compliance officer?
No. Ali's the as the host. I stamp it.
Yeah.
Great. So let's finish up. We asked all our guests some of their favorites, kind of rapid fire here. So I'll just run through them. favorite Carolina barbecue spot, if you have one, or were you too little?
I mean, my hometown in Carolina was Winston-Salem. Was actually supposed to be in the South for a wedding this past month in Charleston. Sadly, they decided to do it, kind of closed doors, family only. There was a spot in Winston called, I'm going to give you two. One was, I think it was called Little Richard's, but also there was a chicken wing place called Ronnie's that is just absolutely just lights out. All they would serve mainly was wings. They had pizza too. You could order off menu, but everyone just ate wings. And I used to have friends come visit. Like, what do you mean you eat wings for dinner? This is before Wingstop and everything else, growing up. They're like, that's an appetizer. You don't eat that for dinner.
These are like super hot or just barbecue?
There's another Winston-based hot sauce called Texas Pete. And if you've ever had it, that was the foundation. If you haven't, it's I think the best hot sauce out there. It's a very distinct taste. So try to grab some online, but totally different sort of hot sauce. But that was the foundation for the wings.
Perfect. Favorite surfing spot out there or anywhere?
I go right in front of my house. So like we're pretty close to the beach. There's a power law here where the further every block up is like 10 times less likely to go surfing for me. Or miles away is like zero chance.
Right, you got to load the boat.
Come surf in Santa Monica or Venice. But just right out front again, it's a very average beach break. But I'm happy to get out there and just embarrass myself.
All right. Well, I grew up in Florida, so I can work my way around the board a little bit.
Too many sharks there. Too many sharks. We come here and we have great whites, but they leave you alone.
Yeah, we used to get a little rubbed on and get out of the water for 10 minutes, like as a 12-year-old. Then you'd be like, all right, it's probably clear. Let's get back in.
Yeah. You see those like drones or plane footage where like goes over a beach and there's all these people and it's just like a shark highway going by.
Yeah, it's scary.
Yeah.
The favorite investing book?
This is one I've kind of been saying for a long time. It's called Triumph of the Optimist. It's expensive, so listeners, you can try to get it in the library, or there's a free download every year that Credit Suisse puts out called the Global Investing Returns Yearbook. Then there's about a decade of the updates for free, all worth reading. And it gives you a history of stock markets, bonds, bills for the past 120 plus years. And the big takeaway in my mind of everything we talked about today was that history, at least having a understanding of what's happened in the past is very useful to at least understand how crazy markets have been, and as crazy as they've been this year. If you study history, at least you have some grounding of what can happen, because it's usually way crazier than people think what's already happened.
So that could never happen again. And all that.
Yeah, we always tell people normal market returns are extreme, and this low vol period of the past handful of years is actually pretty atypical.
So that Credit Suisse thing is different than Triumph and Optimist?
So the Triumph the Optimist was the original book, and then the authors, we've had Professor Dimson on the podcast. He's one of three authors. They do a yearly update, partner with Credit Suisse, that's free. And so they do a different topic each year. So one year it'll be like ESG investing or emerging markets, or one year they did momentum. And you get, the book is a beautiful coffee table book anyway. So you should all get it. But the updates are all worth reading too.
Favorite In-N-Out burger order?
It's funny. One of my first In-N-Out experiences was so embarrassing, where it's, if you've ever been to an In-N-Out and you're listening, or you've never been to one, it's just picture every single day is a line around the block still. And there was a couple near my office, and I had ordered, they have an off menu, and just the menu is like hamburger, cheeseburger, fries. That's it. But there's like 20 different ways you could order them if you know the secret menu, and I didn't. And so I heard someone mention they had a veggie burger, and so I thought I would try their veggie burger. I was living in San Francisco and in that mood at the time, as one would do in San Francisco. and you couldn't go back because the line was like 30 minutes, and it came out and it was just a hamburger without the patty. So it was no veggie burger patty. It was just essentially
bun
with lettuce, tomato, and ketchup. And I was so sad. But other than, I'm an easy cheeseburger guy. I don't need to go animal style double. I love their fries. That's a big area of contention for a lot of people. A lot of people don't like them. I love their fries.
Favorite Denver Bronco of all time?
Elway would be the default. Certainly had a life-size poster of him growing up in my room. There used to be a charity event thing where you could get your picture taken with the Broncos, and it'd be a lottery. So you just invariably end up with like the lineman or like the 4th-string running back. But as a child, you didn't care. So I have some really great photos growing up. I was always a huge Carl Mecklenburg fan.
Yeah.
A Hall of Fame linebacker that was kind of undersized. I think he was like a 12th round draft pick. So I'm
Steve Atwater.
Yeah, he just got nominated, or he just got accepted to the Hall of Fame. He was awesome. But yeah, there's Three Amigos, all those very defining, like I said earlier, like going through the real visceral pain of loss and hope and expectation and loss again was a very nice preparation and grounding for financial markets and getting humbled as well. I have a lot of common sympathy and pain with all of our Bills compatriots too.
It's been tough. And lastly, ask all our guests favorite Star Wars character.
What quarantine has done for me, so all the nerds on here can appreciate. Underrated is that the cartoon series Star Wars Rebels.
Yes.
Great, actually, great series.
Ahsoka, you're gonna go?
Yeah, so she just got cast. I think it's Rosario Dawson. We'll see if she does a good job. The Mandalorian. Favorite character?
Besides Rebels, the other animated one's really good too. I'm drawing a blank right now, but
Clone Wars.
Clone Wars, yeah.
I thought the Rogue One was really well done. Fun story is when I was living in San Francisco, one of my buddies is an actor, and they had his like publicist or somebody's like, hey, the premiere of the very first one, do you want, like, MTV is going, did you want to go with MTV to go to the premiere? And he said, I can't, Meb, do you want to go with a couple of friends? We have like 3 tickets or whatever. And so got to see it at Skywalker Ranch.
Oh, wow.
Which was, George Lucas's place. They like separated us from all the stars, Samuel Jackson and everyone else. But and
then it was a huge letdown, right?
Yes, but it was so exciting to be there that it didn't really matter. They had there was a pit for the symphony to play right in front of they weren't playing live, but to compose the score. Anyway, that was another defining, certainly, of the childhood. I still have my mom still has the Darth Vader carrying case with all the toys in it.
I had that one and the C-3PO case.
Oh, I know. I never had that one, but
they're out there somewhere.
To go dig them up. So my favorite character, I don't know. I'm stumped on that one right now.
We'll give you Ahsoka for now.
Yeah, she's great. She's great.
All right, man. Well, thanks so much. It's been fun. Let everyone know where they can find all the good blogs and podcasts and everything you've been talking about.
Yeah, not too many Mebs out there. So blog is mebfaber.com. Twitter, mebfaber. My day job, Cambria Investments or Cambria Funds, and then the podcast too.
All right. Thanks so much. We'll talk to you soon. Best of luck.
Blast. Could have done this many more hours.
I know. I could have gone deep into some stuff. But
do it again.
For sure.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you.